Most traders spend too much time thinking about entries. They look for the perfect setup, the perfect indicator, the perfect breakout, the perfect chart pattern. But in options trading, the entry is only one part of the trade. What happens after you enter matters just as much, sometimes even more, because options move differently from regular stocks. Time decay can hurt you. Volatility can change. The price can move in your direction, but the option may not move the way you expected. And if you do not know how to manage the trade, a good idea can still turn into a bad result. That is why trade management is so important. Today, let's talk about 5 simple trade management techniques that every options trader should understand. The first technique is to define your risk before entering. Before you buy any option, before you sell any spread, before you click the trade button, you need to know one thing clearly. How much can I lose? Many beginners enter a trade first and think about risk later. That is a mistake. Your risk should be clear before the trade starts. If you are buying an option, know how much premium you are risking. If you are trading a spread, know your maximum loss. If the trade goes wrong, there should be no surprise. The worst time to decide risk is when the trade is already moving against you. That is when emotions take over. So before every trade, ask, where am I wrong? How much am I willing to lose? At what point will I exit? This simple step can protect you from emotional decisions. The second technique is to set a profit target before the trade. Many beginners only think about how much they can make, but they do not know when to take profit. So when the trade moves in their favor, they freeze. They think, should I close now? Should I wait? Can it go higher? What if I leave money on the table? Then the trade pulls back and the profit disappears. That is why you need a plan. Maybe your goal is to take profit at 25%, maybe 50%. Maybe you take partial profit and let the rest run. The exact number depends on your strategy. But the important thing is this: do not wait until emotions are high to decide. A profit plan helps you avoid greed. It reminds you that winning trades still need discipline. The third technique is to respect time decay. This is one of the biggest differences in options trading. With stocks, you can hold and wait if your idea still makes sense. But with options, time is always moving against you, especially if you are buying options. Every day that passes can reduce the option's value. That means you cannot only be right about direction, you also need to be right about timing. A stock may move up later, but if your option expires too soon, you may still lose. That is why trade management matters. If the trade is not moving as expected, do not ignore time decay. Ask yourself, is my setup still valid? Is there enough time left? Is the option losing value too quickly? Sometimes the best decision is not to wait. Sometimes the best decision is to exit and protect capital. The fourth technique is to adjust only with a reason. Many options traders hear the word adjustment and think they should always fix a trade. But not every losing trade needs an adjustment. Sometimes a losing trade should simply be closed. Adjustments can be useful, but only when they are planned and logical. Do not adjust because you refuse to accept a loss. Do not add risk just because you want to recover. Do not turn a small problem into a bigger problem. Before adjusting, ask, does this adjustment reduce risk? Does it improve the trade structure? Am I following a plan, or am I just hoping? A smart adjustment is risk management. A desperate adjustment is emotional trading. Know the difference. The fifth technique is to use a trade journal. This may sound basic, but it is one of the most powerful tools for options traders. Because options have many moving parts: entry price, strike price, expiration date, implied volatility, time decay, profit target, exit reason, mistakes, emotions. If you do not track these things, you are guessing. A trading journal helps you see patterns. Maybe you enter too close to expiration. Maybe you hold winners too long. Maybe you take profits too early. Maybe you trade too large. Maybe you lose most when volatility drops. Without a journal, you may never see the real problem. The goal is not just to record trades. The goal is to improve your decision-making. After each trade, write down what happened. What was the plan? It can help you avoid panic exits. It can help you avoid greedy holding. It can help you avoid turning small losses into big losses. Remember these 5 techniques. Define your risk before entering. Set a profit target before emotions take over. Respect time decay. Adjust only with a real reason. And journal every trade. Simple does not mean easy, but simple rules can protect you from expensive mistakes. In options trading, your goal is not to win every trade. Your goal is to make better decisions over time. Because one good entry does not make you a good trader. Good management does. Educational content only.